Hey there guys, and welcome back to Alex Invests. And today the markets are recovering a little bit, and it's nice to see, because what I've been saying for the past few days, and I will continue to say this, is we are not in a market crash right now. This is just a correction. All we've seen is sort of the gains wiped out for the last month and a half, right? We're at sort of the same levels, especially for these growth stocks, I like these growth stocks, sort of the last January and February gains have been wiped out, and we're sort of back to beginning of January, end of December prices here, and it's not a bad thing. And we're going to look at a couple reasons why this is a correction. We're going to start off by looking at the volatility index and what we see there. We're going to take a look at a few of the stocks that I've been continually buying throughout this dip. And we're also going to take a look at inflation and why inflation is so important to understand, and why it actually doesn't have as much of an effect as people think it's having right now. And it's worrying people, yes, and that's why the prices are coming down as well, because of bond rates going up and nobody buying these bonds. But we're not going to talk about bond rates and these bonds today. We're going to talk about inflation, the volatility index, and the stocks and what I've been buying. So that's what we're going to talk about. And we're going to start with the volatility index, which is right here. Right, the VIX. And what do we see? We see back here in sort of end of January, beginning of February here, we had high volatility. And what did we see? We saw that was around that AMC GME stuff that was going on, right? And we saw the markets come down heavily for 3-4 days here. And again, markets came down, volatility came back down a lot. And then what do we see? We see another bull run. We see markets continually going up and up and up. And now we see big spike, and we saw markets come down. Now we're seeing volatility come back down, and markets are going back up. And the thing about volatility, right, and the stock market and corrections is when we have a correction, we have high volatility, meaning we have high spreads between the high and the low of the day, right, on a lot of these stocks and on the market in general. And when we have a crash, we usually don't see that. We just see, everything going down, and that doesn't necessarily mean high volatility, because we're not seeing a high spread between the highs and the lows of the day. And that is why this is a correction we're seeing and not a stock market crash. We can already see things are turning around here. Volatility, again, like I just showed you guys, is coming down, and the markets today, right, have been recovering a little bit. Yes, they're coming back down now, but earlier in the day we saw some nice recovery. We saw a lot of green. And it's good. And let's just take a look at some of the stocks that I've been continually buying throughout this. Solar.v, I bought more because I'm down on this one quite a bit. And so I just been picking up more and more shares here. AAZ, I'm down a lot on this one too, and I still think it's going to do well. So I bought more shares here as well. Again, I see a recovery coming, guys. It's not a crash again. This is just a correction here back to sort of the beginning of January prices. And the reason for that is likely that people are worried about inflation coming. And as people are worried about inflation coming, inflation actually comes more. So keep that in mind as well. And some of the other things here, look at Cielo Waste Solutions, guys, CMC, right? I did a video on these guys a few days ago when it was at that sort of 0.38 level. And since then, we've just seen a huge run in this one, over 100%, right? 65% today. Interesting to see, good to see. What do I see from here? Well, again, I see the price much higher in the future, but again, we could see it come back down in the meantime, because yes, we've had some insane runs. So I just wanted to show you guys that. I bought a little bit of CRNT as well. CCIV, I also have been actually continually buying here, because I see this one actually as a very good long-term play. Very Good Foods, if you're down on Very Good Foods right now, I think it's a very good time to buy Very Good Foods as well. Fuel Cell coming up again now too. We're seeing some nice recovery there. I don't see us ever coming below this $15 level, except for the other day when we saw obviously that $13.89 level instantly jump back up. We're not seeing that price again, guys. I'm telling you that right now. Plug again up 11% today, and this is nice to see, a little bit of recovery. So those are just some of the stocks I wanted to show you, right? And again, we are going to recover in all these, and that's why I'm not worried about it. Now, the final thing I want to go over with you guys, and this is the most important. If you guys learned one thing from this video, it's the inflation here that people are worried about. And we're going to go through why people are worried about inflation and potentially why people shouldn't be as worried about inflation as they currently are. And the easiest way to explain this is going to be looking at my iPad and just explaining to you guys how inflation works and how it has an effect to the negative, but also to the positive in the stock market. There's a give and a take here with inflation, and that's what's very important to understand about inflation. So that's what we're going to go over here, right? And this is it right here, blank right now, right? But we're about to make it not blank. So how do we value the price of a stock? Well, one way is to use a DCF statement, right? And that's a discounted cash flow statement. We're not going to go over DCFs today, but one day maybe we will, because I do use them from time to time, and they are good to value a stock. But the way you basically start by making a DCF is determining the present value of future cash flows, right? And what that means is we're trying to find what the present value is of a certain future amount of cash. And in this case, you know, when you're doing a DCF, it's cash flows, right? But for now, we're just going to worry about present values, right? And so let's say the future cash, and we'll make it super simple, right? And so we'll take, in a year's time, how much is a company valued today? So let's say the future cash flows of a company 1 year from now is let's just make it super easy, $1,000, right? And so this is how much the company is going to make in the next year, $1,000, right? In 2022, they will make $1,000. And so we have to determine, in order to find the price of a certain stock, we have to determine what the present value of this $1,000 is. And once we do that, then we can determine what the price of the stock should be from there. But let's just worry about the present value of this $1,000, right? And the way you do that is you divide this $1,000 by 1 plus the interest rate plus the inflation rate, guys. And so we'll go through a more specific way to do this, or we'll go through an actual example here in a second, but the interest rates we know are very low right now. Let's say they're about at 2%, right? And inflation we know is even lower right now, or has been, so let's put that at 0 for now. So the present value of $1,000 is 1,000 divided by 1 plus 0.02, which is 1.02, right? And we get from that, and let me just get out my trusty Siri calculator here for a second, 1,000 divided by 1.02 is $980, right? And so that's nice. That's not bad. So $980 is what this $1,000 next year is worth today, right? And you can calculate the stock price from that with a DCF, right? DCF, not DFC, DCF. Sorry about that. But again, let's just worry about this, right? So now we have inflation is above 0 because people are worried about inflation. They're worried inflation is going to come. So again, what does that do, right? It means that the dividing number comes up. So now we have 1,000 divided by 1 plus, again, the interest rate. Let's say we know interest rates are going to stay the same for the next at least 1 year, so it's still 0.02, but now we have the inflation rate, and let's say that's also 2%. So now we have 1,000 divided by 1.04, and that gets us, again, trusty Siri calculator here, 1,000 divided by 1.04. And that, I could have guessed that one, gives us $961 about. So what do we see? We see that the present value of our future cash is worth less when we have higher inflation. And what that causes is it causes a decrease in the price of the stock, because now the future cash that we can potentially make is worth less in the present. And again, with common sense, we know that that's going to push down the price of the stock, because now the present value isn't worth as much anymore. So the price isn't worth as much anymore. And this is what people are worried about, that as we see more inflation, we're going to see the present value come down, and that means the price of these stocks comes down. And that's what we're seeing, right? And that's why inflation hurts stocks and hurts the stock market, because the present value of our money is no longer worth as much, But there's another thing to this, and we're just going to do it right below here. And that is the fact that because we have higher inflation, now we have higher prices as well. And that's, of course, if these companies choose to raise prices, but every rational company chooses to raise prices as inflation becomes up, because of exactly this reason, that your future cash isn't worth as much in the present anymore. So what we get from that now is we get, since prices are higher, that means our future cash flows are also higher, because we're selling our units for more. So let's take Fuel Cell Energy, for example. They sell fuel cells. So fuel cell now sells at a higher price than they sold for when we had a lower inflation, which means F-Cell's future cash flows go up. So now this $1,000, let's say, turns into $1,200, because the price of every single unit that they've sold has gone up by, let's say, 2% again, right? And I know this is 20%, but they also are selling each unit for more. Well, yeah, this should be 1,020. So let's say it's 1,020, right? Now, if we divide this by 1.04, we get $980. $980, which these two are identical. And that's why people are worrying about inflation, when in reality they need to worry less about inflation. Yes, it's still a worry, of course, and bond rates going up shows that inflation might come up, and that is going to potentially decrease the present value, or it will decrease the present value. But again, for some of these companies, as we see, future cash flows go up because of inflation, because prices have now gone up. It doesn't hurt the economy, or it doesn't hurt the stock market, it doesn't hurt the price of these stocks and as much as people think that it will. So that is something that you guys really have to keep in mind here, and it's very, very important that you do keep that in mind. So that's really what I wanted to show you guys there. There is a third thing about inflation, right? Because as inflation goes up, the economy tends to slow down. But because we're seeing the economy speed up here anyways, we're not going to see the economy actually slow down more than it's slowed down now. And in turn, that third really doesn't matter either here, because the economy's speeding up as, we beat COVID and we get back to normal. People are spending money again, right? And the velocity of money has to do with this, right? As well as more people are spending throughout the economy, the velocity of money goes up, and that in turn also increases inflation. Yes, but again, the economy's moving more. We're seeing. We're not seeing the economy slow. We're actually seeing the economy move faster. So and go back to normal, right? So that's important there. Now, we've already gone through some of the stocks I've been buying throughout these dips. Next week, who knows what's to come, right? The stock market could go down, the stock market could go up. We never know. But what I do know is that this is just a correction and not a crash. And if you do anything, buy throughout this dip or just hold what you have, guys, because we're going to see prices in the stock market recover. It's not worrying me at all. And other than that, I hope you guys have a fantastic day. I hope you guys have a fantastic weekend. I will not be filming this weekend, but I will see you guys on Monday morning. So stay tuned for that. And again, just enjoy the dip, enjoy the weekend, and don't think too much about it unless you're buying through these dips, okay? Don't even look at your portfolio unless you're planning on buying. And don't worry about some of the decreased gains that you've gotten in the past little while, guys. We will see recovery. Think 2-3 years down the road here. Do not think the next 30 days. Do not think the next 2 months, because if you're looking to make money in the long term in the stock market, you have to think long term in the stock market, and you got to think about these companies that you know are going to do well in the future. And these days on the downs, they don't matter at the end of the day. So I hope you guys liked this video. If you did, please like, subscribe, and leave me a comment. And other than that, again, have a fantastic weekend, guys.